Yo, what's going on guys? My name is Nick, and if you're new to the channel, welcome to Investing Engineered. Today, I'll be sharing with you some of my absolute favorite exchange-traded funds, or ETFs, and these will absolutely help you achieve your long-term financial goals. In this economic environment where literally everyone on YouTube is posting videos about the next recession happening, we as investors need to be wise and start looking for defensive alternative approaches to investing. And one of the best ways to do that is through passive ETF investing, where literally you can just let go of the wheel, let the market do its thing going up and down, but over the long run, this will provide you solid returns. Furthermore, this approach will allow you to get into the market immediately without having to worry about your individual investments. So that means you won't have to research companies all the time, you won't have to read annual reports, and so this is truly the key to earning passive income. And the best part about ETF investing is that the fees are extremely low, so you won't have to worry about these fees eating away at your returns over the long term, and so you can take all of the capital gains and dividends that you receive. So if you guys do enjoy the video, be sure to smash the like button for the YouTube algorithm, and also be sure to subscribe if you haven't already for more weekly videos just like this. And so with that said, let's jump into my top 5 recommended Vanguard ETFs for anyone looking to invest passively. Alright guys, so the first ETF that I would strongly consider for my own portfolio for passive investing is the Vanguard Real Estate ETF, ticker symbol VNQ. As we all know from Graham Stephan and Meet Kevin, real estate can be a truly lucrative investing avenue when done right, and this is especially true with passive investing through ETFs. So this ETF that we're looking at today tracks the performance of the MSCI US Investable Market Real Estate 25/50 index, which basically means that it's tracking a bunch of REITs, which are real estate investment trusts, as well as other real estate holding companies. In fact, this ETF holds a variety of real estate holding companies, ranging from large cap to mid cap to small cap companies, providing a very diverse mix. So its top 10 major holdings consist of the top REITs within the United States, like the American Tower Corporation or the Crown Castle International Corporation, both of which have performed very well over the past history. So obviously you'd think that that would give an indication of the past performance of this ETF, right? And yes, this ETF has performed extremely well over the past decade, having an annual compounded growth rate of 12.9%. Even if we consider its performance since 2004, which actually includes the Great Recession in 2008, its performance has still been 9.2% per year. And so obviously from this all-time chart, we can find that the ETF has performed extremely well in the past, and especially well over the past year where it's been on an absolute tear. Now in my opinion, I think this great recent performance is due to the fear within investors of an upcoming recession happening, and this is because people want to pile their money into safer investments that pay dividends. And according to Google, this ETF actually pays an annual dividend yield of 3.78%, which is also known as a distribution for ETFs. So if you're looking to make some great passive income along with capital gains, this ETF is definitely for you. As for fees, VNQ only has a management expense ratio of 0.12% for holding this ETF, and this is deducted from the annual returns. Now, despite how low you think this fee might be, it actually gets a lot better for the other ETFs, so I wouldn't consider this extremely low. But as you can see, this is still going to be significantly lower than many other real estate ETFs out there. So overall, I think this is a great real estate play, especially if you're looking to invest passively, earn some passive income, but also achieve really high market returns. But personally, I wouldn't buy this ETF immediately because it has been on a tear in 2019. And so I would wait for a pullback and definitely keep this one on my watch list. All right, so the second ETF that we have on the plate today is the Vanguard S&P 500 ETF with ticker symbol VOO. Now this ETF is a classic, and that is because it tracks the most important index out there in the United States, and that is the S&P 500 Composite Index. So this is definitely a fund for everyone's portfolio. VOO holds some of the most popular brand names that you'll know, just like Microsoft, Apple, Visa, Procter & Gamble, just to name a few. Now obviously the most important part that we care about here is the historical returns, and what it's shown is a 14% annual compounded growth rate since its inception in 2010. However, it should be noted that this ETF performance does not include any recessions, like the most recent one in 2008, so on average the performance should be about 10% per year. Now just like the previous ETF, VOO does pay out dividends in the form of distributions to its shareholders, and this is at a current annual yield of 1.94%. Now, obviously, you won't be getting the largest dividend yield you'd hope for, having such a large mix of dividend and non-dividend paying companies, but nevertheless, it's nothing to scoff at, and 1.94% is pretty solid. In addition, for this ETF in particular, the fees are extremely low, being at 0.03% as an MER in 2019, and so that's pretty amazing. So overall, I'm personally a huge fan of this ETF because it tracks the general market performance and you're guaranteed to get those market returns. And in order to get those market returns, I would make sure to dollar cost average my position as I build it up. And so overall, I would strongly recommend this ETF with the dollar cost averaging approach. All right, guys, so the third ETF that I have for passive investing is the Vanguard High-Dividend Yield ETF, ticker symbol VYM. In fact, this one is a solid play for passive income investing, so you can basically sit back, dollar cost average into the fund, and then receive dividend payments for the rest of your life. So as you guys can see, the fund is very well diversified amongst many different sectors. However, there is emphasis on the financial sector because this one is very well known for its dividend payments and its history for increasing the dividends. But you will still find other big companies with major brand names like Johnson & Johnson, Coca-Cola, Procter & Gamble, etc. So in terms of its historical performance, this ETF has done very well because it does include a lot of the S&P 500 companies, because these are the top companies in America. And this ended up coming out as an annual average of 12.7% per year over the past decade, and this is slightly below the market average. But even though the performance is slightly below that of the S&P 500, you're actually going to be getting a lot more in passive income through dividend payments. So over the past year, this ETF has paid out a solid dividend yield of 3.37%, which is a lot better than the S&P 500 average. So that means all of you passive income investors out there can rejoice. And finally, the fund only has a management expense ratio of 0.06%, which is slightly above the S&P 500 average, but regardless, it's extremely low. So overall, I would definitely consider adding this ETF to my portfolio because I feel it would provide great long-term value, safety in the market, but also great dividend payments for passive income. All right, so the fourth ETF that we're gonna look at today is the Vanguard Total Stock Market ETF, which has the ticker symbol VTI. Now this ETF is very similar to the S&P 500 ETF that I spoke about a little bit earlier. However, it does include every single stock in the US stock market and not just the top 500 companies. Now the advantage of this is the additional diversification that you're gonna get outside of those large cap companies. So that means you're gonna be including all of the smaller cap and more risky stocks. In total, the fund holds 3,560 companies across the entire US stock market. And so if this isn't enough diversification, I do not know what is. And in terms of performance, this ETF has done very well over the past 10 years, having an annual compounded growth rate of 13.1%. Now this compares to its annual average rate of return of 7.2% since its inception in 2001, and this is generally what you would expect for the S&P 500 as well. Now, along with the notable capital gains, this ETF also does pay a dividend or a distribution, and that is at a yield of 1.86% in 2019, which is slightly below the S&P 500 average, but it's still pretty good. And finally, the fees are exactly the same as that of the S&P 500 ETF, being 0.03% as an MER, and this is insanely low. But overall, I would personally choose the S&P 500 ETF over this total stock market index ETF, and that is because it would only contain the top 500 companies and would totally exclude all of those smaller and riskier companies. But also the S&P 500 ETF pays a slightly higher dividend. All right, guys, finally, the last best ETF that I would recommend for passive investing is the Vanguard Growth ETF, ticker symbol VUG. Now, before I get into the details, it should be noted that this ETF will provide significantly more growth, but that does come at the cost of extra risk. And that is because many of the companies contained within this ETF can be overvalued at times, as it is heavily weighted towards technology companies like Amazon, Google, Apple, etc. Now, generally, when the market is performing very well, like the bull market that we're in right now, this growth ETF is going to outperform the S&P 500 And we've seen that over the past 10 years having an annual compounded growth rate of 14.4%. Now, even since its inception in 2004, this ETF has posted excellent returns since then, which was before the Great Recession, and this actually comes out to 9.2% per year on average. But unfortunately, when you have very high growth companies like you'll see in this ETF, it means that they're not going to be paying very high dividends at all, or even not paying a dividend at all. And that is because they're investing a lot of this capital back into their businesses to promote more growth. So in this case, the dividend yield for this Vanguard Growth ETF is only 1.07%, and that is significantly lower than the S&P 500 ETF. And finally, just like the others, VUG has a very low expense ratio, being at 0.04% annually. So overall, I personally think this fund has a lot of potential for young investors looking to take a little bit more risk and get those higher returns. However, I would buy this on a dip because it could crash hard in the next recession. So overall, guys, if I had to recommend a single ETF out of this bunch to pick for my portfolio, it would be the S&P 500 ETF VOO. And that is because it provides broad diversification amongst the top 500 companies in the United States, so you don't have to worry about the lower cap risky ones. But also it has the lowest fees amongst all of these ETFs that I've talked about, being at a 0.03% MER. But if you've already been in the game for a while and you do own that S&P 500 ETF, definitely consider the other ones because I think they'll be great long-term plays. And with that said, thank you guys so much for watching the video today. If you did enjoy or gained any value from this video whatsoever, be sure to smash the like button for me to support my channel. And if you haven't already, be sure to subscribe for more content on personal finance, business, and investing in the near future. Until next time.